Here are 7 completely legal ways to pay less tax on your crypto, and most people never touch a single one of them. Same coins, same portfolio, same buys and sells you already made. The only difference is the person who knows these rules keeps a lot more of the money, and the person who doesn't hands a big chunk of it over to the IRS for no good reason. Quick note before we start. This is education and not tax advice. I'm going to show you how these rules actually work so it finally makes sense in your head. For your specific situation, make sure to talk to a professional, and I'll make that easy at the end. I'm Alex. I co-founded Token Tax back in 2017, and I'm not going to pretend I'm the most decorated tax accountant alive. What I am good at is connecting the dots and knowing the right questions to ask. And I've watched a lot of people go from overpaying every single year to keeping thousands more just by using a few of these. Strategy 1 is the biggest one, and it's almost embarrassing how simple it is. Hold your crypto for more than a year before you sell it. What that does is, if you buy a coin and sell it inside of 12 months, any profit gets taxed as short-term gains, which the IRS treats just like your regular income, at your regular income tax rate. That can be a painful number. But if you hold that same coin for more than a year and then sell, the profit is long-term gains. And long-term gains get their own special rates, 0%, 15%, or 20% depending on your income. And that gap is huge. You could buy a coin, sell at the exact same profit, and the only thing that decides whether you're taxed at your top income rate or as low as 0 is whether you held it for 11 months or 13. Same coin, same gain, and the calendar is the whole difference. So before you sell anything, the first question is always, how long have I held this? A lot of people accidentally sell a month too early and turn a low tax gain into a high tax one. 2 more months of patience is sometimes worth more than picking a better coin. Strategy 2 feels backwards the first time you hear it. You sell the coins that went down, and on purpose. It's called tax loss harvesting. And here's why it works. When you sell a coin that dropped below what you paid for it, you lock in a loss. And that loss is worth something because it cancels out gains somewhere else. So if you made $10,000 on one coin this year and you're sitting on another that's down 10,000, selling the loser wipes out the tax on the winner. On paper, you came out even, and you owe nothing on that gain. The part people miss is that the loser is doing real work for you. Normally, you would just hold the coin that's down and feel bad about it. But that red position is a tool. Sold at the right time, it shrinks the tax bill on everything that went up. So I actually experienced this myself back when DeFi was just getting started. I was a huge believer in the project called Yearn Finance, and they had a token called YFI. So I made a nice profit early on, but I kept buying more as the project grew. Unfortunately, those later purchases ending up losing money for myself. At the end of the year, I ended up selling the YFI that I was holding at a loss. Those capital losses didn't go to waste. They ended up carrying forward, and in later years, I used them to offset some gains that I made in some stocks. That ended up saving me a huge amount in taxes. Strategy 3 picks up right where that leaves off. And it's the part that surprises people. What if your losses are bigger than your gains? Say you locked in more losses than you had winners to cancel. The leftover loss doesn't just disappear. Up to $3,000 of it comes straight off your regular income, the income from your actual job, the paycheck kind. So for a bad year, if your crypto is down, it can genuinely lower the tax on your salary. And it gets better because whatever's left over after that $3,000 doesn't vanish either. It rolls forward. You carry it into the next year and the year after that with no expiration until you've used all of it. So a rough year in the market can keep paying you back on your taxes for years afterwards. A lot of people have no idea that the loss they already took is still sitting there, waiting to cancel a future gain. Strategy 4 is hardly one anyone knows they're allowed to do, and it can change your tax bill without changing a single trade. Say you bought Bitcoin at 5 different times over the years, at 5 different prices. Some cheap, some expensive. Then you sell just a little bit of it. The question is, which Bitcoin did you sell? Because it matters a lot. If the IRS assumes that you sold cheap coins you bought years ago, your gain looks huge and your tax is high. But you're allowed to specifically identify which units you sold. And if you point to the most expensive coins you bought, the gain shrinks, and so does the tax. That approach, selling your highest cost coins first, is often called HIFO. Highest in, first out. Same sale, same amount of crypto leaving your wallet, but you told the story in the order that costs you the least tax. legally. Now, doing this has real rules. You have to identify those specific units correctly and keep the records to back it up. And that's genuinely tricky across a lot of trades. That's exactly the kind of thing my team handles all day. These strategies can only work if you can prove them. And proving them means one clean, honest record of every buy, every sell, every price, every date across all of your wallets and exchanges. And you can absolutely keep those records for yourself. Plenty of people do. Or you hand the messy pile to people who reconcile crypto for a living and get clean numbers back, which is the whole reason token tax exists. Link in the description. Strategy 5 is for anyone who gives to charity anyway, and it's a genuine double win. Say you're going to donate to a cause you care about. Most people sell some crypto, pay the tax on the gain, and donate what's left. But if you donate the coin itself directly to the charity instead of selling it first, two good things happen at once. You don't pay any capital gains tax on that coin because you never sold it. And if you held it for more than a year, you generally get to deduct the full market value of the coin as a charitable gift, not just what you paid for it. So picture a coin that you bought for $1,000 that's now worth $10,000. Sell it and you're taxed on $9,000 of gain before a dollar reaches the charity. Donate the coin directly and you skip that gains tax completely, and you deduct the full $10,000. The charity gets more and you keep more, and the only thing you give up was writing a check you were going to write anyway. Strategy 6 is the same energy, but pointed at people instead of charities. You can gift crypto. In 2026, you can give any one person up to $19,000 of crypto a year with no gift tax and no form to file. If you're married, you and your spouse together can give the same person $38,000. Handing someone crypto isn't a sale, so you don't trigger a taxable event by giving it away, and the person receiving a gift doesn't owe income tax just for receiving it. But here's the one thing that makes crypto gifts different from handing someone cash, and it's the part that catches people. When you gift a coin, your original cost basis travels with it. So if you bought that coin for cheap and it's way up now, the person you gave it to inherits your low starting price, and that gain comes due when they eventually sell. It's a great way to move money to family, as long as everybody understands that the coin carries its tax history with it. The gift is easy. The record that rides along is the part that you can't lose track of. Strategy 7 is the one that makes people's eyebrows go up, so I saved it for last. Every strategy so far has been about selling smarter. This one is about not selling at all, because the moment you sell a coin, you trigger the tax. But if you need cash and you don't want to sell, you can borrow against your crypto instead. So the way this works, you put the coin up as collateral and you take out a loan. This is the whole trick. Taking out a loan is not selling. You still own the coin, so there is no disposal, which means there's no taxable event and no gains tax on the money you just pulled out. Think about what that actually means. You can get liquid, spend money, and never trigger a single dollar of capital gains because you never sold. Your coins stay yours. They keep whatever gains they've got, and the tax clock never starts. Now, this isn't free money. A loan is still a loan. You owe it back with interest. And if the coin's price crashes hard, the lender can sell your collateral, which would trigger the tax you were avoiding. So it's a real tool with real risk, not magic. But used carefully, borrowing instead of selling is how a lot of people access their crypto without handing over a cut every time. So at Token Tax, we've worked with multiple clients who wanted to buy homes, but had a large percentage of their net worth tied up in crypto. Traditional mortgage lenders typically don't view crypto as a reliable source of income, which can make it difficult for our clients to use those assets when seeking mortgage approval. In these situations, we've seen clients borrow against their crypto to access cash for the down payment. This allows them to avoid selling crypto and potentially triggering capital gains while still getting the liquidity they need for the home purchase. The important point is that they need to borrow conservatively and maintain a healthy loan-to-value ratio on the crypto-backed loan. Because crypto prices can be volatile, borrowing too much against the collateral could create the risk of a margin call. This is a request for additional collateral or forced liquidation if the value of the crypto drops. Obviously, we don't want that, and we encourage people to avoid that at all costs. By keeping a large collateral cushion, people can reduce the risk that market volatility may create for the crypto loan. One trade-off is that the person is now responsible for paying back two loans, the crypto-backed loan and the traditional mortgage. That said, in these situations, the cost of carrying the crypto loan was cheaper than the capital gains tax the person would have triggered by selling the crypto to fund the down payment. They can then use the cash from the crypto-backed loan for the down payment and qualify for the traditional mortgage using their other sources of income. And that's the whole reframe of this video. When most people ask, how do I get rich with crypto? They're asking which coin should I buy? But every single strategy here has nothing to do with picking a better coin. Same portfolio, same trades, and the person who plays the tax side ends up keeping more money by holding longer, harvesting the losses, carrying them forward, picking the lots, donating, gifting, or borrowing instead of selling. You can't control what the market does. You can control how much of your gain you get to keep. That's the game almost nobody is playing, and it's the whole reason you can end up with multiples more in your pocket from the exact same coins. So there are your 7. Hold it past a year for the lower rate, sell your losses to cancel your winners, let the extra losses knock down your regular income and roll forward, pick which coins you sold so the gain is the smallest, donate the coin and skip the gains tax, gift it and hand off the basis, and borrow against it instead of selling so you never trigger the tax at all. Every one of them is legal, and every one of them comes down to knowing the rule and keeping the record to prove it. That second part, the record, is the whole job. It's where most people fall down. So the only real decision left is whether you track all of this yourself, now that you know what to look for, or you hand the messy part to people who reconcile crypto and file it every day. That's the whole reason token tax exists. The link's in the description. And I've got another video for you that goes deeper on exactly this. Go watch that one. I'll see you over there.